Good morning from our global headquarters in New York. I'm Danny Berger. Manus Cranny is off for the week. Welcome to Bloomberg Brief. Let's set your agenda. Oil slumps, crude drops for a third day on speculation that Israel will not strike energy sites in Iran. Another record, stocks notched their 46th all-time high of the year. Nvidia posts its first record since June. And bank earnings continue. Bank of America, Goldman Sachs, and Citi all on deck. So we await the earnings. We also have J&J reporting today, too. We're going to get Netflix later in the week. Weaker across the board for your equity futures this morning, led down by NASDAQ 100. We did have our 46th record high, and Bank of America pointing out that investors added the most to equity since June 2020. We are at peak optimism. For this bond market, not a whole lot of movement this morning, maybe slightly lower across the curve, save for the front end. Yesterday was a holiday for this bond market, so not a lot of movement. Maybe some of the reason the longer end is coming down is because of oil. Let me show you this quickly. Down 6.3% over the past 2 days. That follows a Washington Post report that if Israel conducts a strike, it would be on military sites, not energy. So some of that geopolitical risk premium getting priced out here. We've also had a lot of Fed speakers really over the past 2 weeks, and the strong data, it continues to defy fears of a harder landing. And Minneapolis President Neil Kashkari said yesterday that it appears that further modest reductions would be appropriate. Meanwhile, Governor Christopher Waller spoke on the path ahead, also with less urgency.
This data is signaling that the economy may not be slowing as much as desired. While we do not want to overreact to this data or look through it, I view the totality of this data as saying monetary policy should proceed with more caution on the pace of rate cuts than was needed at the September meeting.
Joining us now is Andrew Sheets, Global Head of Corporate Credit Research at Morgan Stanley. Andrew, thanks so much for joining this morning. It's really great to see you. So modest reductions, further caution. It's a Fed official after Fed official trying to steer us away from the rapid easing. What in your mind does this path actually look like for the rest of the year?
Yeah, thanks, Danny. Good morning. It's great to be here with you. So I think what we're looking at is a modest reduction. Our view at Morgan Stanley is that the 50 basis points that we got in September wasn't some new pace setting. It was a larger kind of one-time adjustment, and that the pace from here is going to be 25 basis point cuts, much more modest reductions. And if the data comes out better than the Fed expects, then maybe they could even do a little bit less than that. And I think for markets, that's good. I think if we look back at history, the Fed doing a little bit less than expected, the Fed easing in a shallower pace is fine, as long as that is accompanied by good data. And in some cases, that's better. That's a better outcome for markets than weaker data and the Fed cutting a lot more.
Yeah, we talked about this last week, Andrew, this idea that good news is good news again. But with that good news, you have seen some more pricing of inflation risk. 5-year inflation swaps, the biggest jump over the past 5 weeks since early March of 2023, just before SVB's collapse. Does there get to a point, and are we anywhere near it, where the good news becomes bad news for risk?
Yeah, no, I think that's absolutely the right question, and that's a question that's been coming up in our conversation with investors. And our view on that is not yet. I think we still have some time before the data is almost kind of too good and starts to worry the market again. And I think there are kind of a couple of specific elements around that. The first is, I think that the metric you mentioned, inflation break-evens, is absolutely the right thing for investors to focus on. And if I think about kind of 2-year inflation break-evens, right, what is the market thinking that CPI will be over the next 24 months? That's at kind of 2.1 in PCE terms. The Fed's target, maybe that's 1.8, 1.9. Still very much kind of in line with inflation being at target or even a little bit below target. Now, I think if we saw those inflation expectations get up to 2.3, 2.4, well, I think then you can start to make the case that the market is saying this is too hot. This is now the Fed losing control a little bit of inflation, but we're not there yet. And also, I think if we just take a step back and think about what asset allocators, investors usually worry about most. Usually, I think what they worry about most is growth rolling over. And if growth holds up, there, I think, are a lot more instances where markets can hold up, and markets can hold up at pretty above average valuations under those conditions.
And you see that in credit markets. I mean, they could scarcely be more optimistic than they are right now. Does that very fact, Andrew, worry you that there's so much optimism baked in despite all of these tail risks from geopolitics to U.S. election and otherwise?
Yeah, so it's not worrying us yet, I would say. So at the moment, we are still forecasting tighter spreads over the next 9 months. We do think this is an environment of a lot of moderation in growth, moderation of inflation, moderation of policy, and we think credit is an asset class that really likes moderation. So for the moment, we think it's fine. I do think, though, we have to keep an eye out over, do we see signs that that's going too far, specifically that companies are looking at those borrowing costs and saying, well, that's great. We're now actually going to be a lot more aggressive, that these spreads are so tight, these yields are so attractive, we're going to borrow a lot more. Because I think in the absence of a recession, and again, this is where the recent data is so helpful, I think it's lowered the odds that the data is deteriorating more rapidly. Well, if it's not going to be that sort of growth downturn, then the other thing that would get credit in trouble would be much more corporate aggression, much more corporate optimism. We're just not quite there yet.
We also were likely to get just the deluge of bank issuance as we work our way through their earnings. Just how favorable are conditions for the financials right now?
Yeah, I think that is something we need to keep an eye on. And I think, again, there's some balance here between there is still some of that supply pressure, but the banks are also reporting pretty good earnings, a quite strong capital position, and that's also helpful. So from our perspective, we're still favorable on the financials relative to non-financials and credit. We like that in the U.S., we like that in Europe, but I do think we need to keep an eye on that supply, and we do need to keep an eye, especially as you move, into the U.S. election and past the election, whether any sort of political or regulatory change shifts that picture.
I wanted to go there to the election, Andrew. How much do you understand of the deluge of debt that we've had over the past few months? Are corporates trying to front run the election? And it looks very different once an American election takes place.
Yeah, no, I think that is an important factor of what's going on. We've seen a lot of issuance. We've seen a lot of issuance in the U.S. We've seen a lot of issuance in Europe. And we do think that this kind of election uncertainty, just wanting to get out ahead of it, get your funding done, kind of not leave a lot of undone funding to the fourth quarter, to the very end after this event, is something understandably that corporate treasurers have wanted to do and are doing. And I think this is the case in the U.S., where obviously that election is much closer to home. But I think this has also been the case in Europe, a reason why European issuance has been so high despite otherwise kind of relatively tepid European growth. And so, our expectation is that issuance will slow post-election, that companies will have done a lot of what they've needed to do. Obviously, we need to kind of see that, but that is currently our expectation, that there's been a lot of front loading this year.
Do you understand how this credit market might react, Andrew, to an election where we don't know for some time what the results are, a contested election, something that even needs to make its way to the courts? Is that risk appropriately priced in?
So I think, this is a hard question to answer. We generally operate under the assumption that credit likes moderation, credit likes stability. And I think the scenario that you imply is a not moderate, not stable outcome. And so it's certainly, I think, more challenging, presents some risks there. Look, I also think that this is a case where the makeup of what Congress looks like under that sort of contested election scenario also matters. I think if you are looking at a scenario where it's more likely to be a divided Congress, then I think the market could look at that and say, well, that reduces the odds of large legislative change. That's good, I think, from the eyes of credit. Again, kind of operating under the idea that credit likes moderation, credit likes kind of cutting off the economic tails. But if it looks not like that, if it looks like we could get a more united government scenario, then that could also raise some greater kind of economic volatility and something that maybe the credit market likes a little bit less.
Andrew, really wonderful to get your thoughts, as always. That's Andrew Sheets of Morgan Stanley. Okay, let's get to some of the other top stories that are trending on your terminal this morning. Chinese tax authorities are moving to collect overseas investment gains from the country's ultra-rich. They've begun to ask individuals to come in for payment evaluations or request a self-assessment. The government has been urgently trying to expand its sources of revenue as land sales have tumbled and growth has stalled. Sources tell Bloomberg that Tesla had humans control some of the capabilities of the Optimus robot prototypes at its recent showcase. Elon Musk was at the event and told the crowd that the humanoid androids would be the biggest product ever, but he didn't disclose the human helpers. The event was intended to generate investor buzz for upcoming products. And Donald Trump's latest town hall in Pennsylvania was derailed after multiple audience members fainted last night. The Republican presidential nominee had taken the stage 40 minutes before. The sweltering heat caused more people to faint, so then Trump pivoted from the usual Q&A format to transform the event into an impromptu dance party. Well, former President Trump will be sitting down with Bloomberg's editor-in-chief, John Micklethwait, for an exclusive interview exactly 3 weeks from Election Day today. Catch that interview 12 p.m. New York time, 5 p.m. in London. But first, coming up on this program, oil extends its losses. Israel signals that it won't target Iran's energy infrastructure in a retaliatory attack. Later in the hour, we're also going to be catching up with RBC's Wu Silverman on the dramatic change in sentiment in the options market. Don't miss that. Stay with us on your Bloomberg Brief. It's your Bloomberg Brief on this Tuesday morning. I'm Danny Berger in New York. Oil prices tumbling yet again this morning, down 4.5% for Brent crude. The Washington Post yesterday reported that Israeli Prime Minister Benjamin Netanyahu has told the White House that he is willing to strike Iran's military rather than oil or nuclear facilities. For more, let's bring in Bloomberg Horizon's Middle East and Africa anchor Jomana Bercecci and Will Kennedy, Bloomberg Senior Executive Editor for Energy and Commodities. Jomana, can you lay out for us exactly what it looks like Israel is now considering?
Yeah, that's the question, Danny, because after the October 1 Iranian missile attack on Israel, it became apparent that Israel was going to respond. And we discussed a whole menu of different options that they could go for. The concern, of course, is that the most nuclear option would be for Israel to go after the nuclear facilities in Iran. But then increasingly, and you began to see this being priced into some of these oil markets, geopolitical concern about the possibility of them targeting oil infrastructure. Now, in the past couple of days, there have been several outlets, not just Washington Post, but also NBC on Friday afternoon, saying that according to their reporting, discussions have taken place at a high level, high security level within the Israeli cabinet, in which focus their response mainly on some of those military infrastructure targets and possibly on IRGC commander level, as opposed to going after nuclear targets or even oil infrastructure. Now, this is key because we know that the U.S. have been exercising some diplomatic influence there. There are ongoing channels open. The Prime Minister this morning, Israeli Prime Minister, put out a statement saying, we listen to the opinions of the United States, but we will make our final decisions based on our national interests. But two other important developments just to note here. Number one, we spoke about this yesterday, the Pentagon has licensed the use of their sophisticated air defense system called THAAD, and that is expected to be operational in the next couple of days. So the U.S. are helping Israel bolster their air defense system. And the second development is that late on Friday, the U.S. also announced that they are introducing further sanctions on the Iranian oil industry, which again is notable because it tells you that when Israel is thinking about the package of response to the Iranian missile attack, it also comes along with some assistance in the form of this sophisticated air defense system from the U.S., alongside those new sanctions that are being applied to the Iranian oil industry as well.
Right. Maybe that's the thing that gets them to listen to the U.S. rather than Biden just demanding it. And well, Jomana mentioned what's happening in energy. Oil prices down another 4.6% for WTI this morning. Just how much geopolitical risk premium has now been taken out of this oil market?
Because if we think back to early last week when people were really worried about Israel hitting Iran's oil facilities, it came after Joe Biden acknowledged that that was part of discussions between Washington and Israel. We saw oil prices hit $80 a barrel, the highest in several months. Now this morning, we're back down below 74. So we can really see that the Brent oil price has responded to a perception that the risk of strikes on the oil market and the impact on oil exports has diminished, and I think the focus increasingly, and it has been for several days, is actually on the state of supply and demand. Some disappointment is common with other financial markets about stimulus from China, and just a sense with OPEC getting ready to perhaps put more oil into the market next year, and concerns about demand, that the oil market isn't looking that tightly balanced as we go into 2025.
Well, just to that point, the International Energy Agency out with a report this morning saying oil's geopolitical risks offset by plentiful supplies, and lists a lot of the reasons you're listing. Does that mean to say even if the geopolitical risk continues to be live and well, that there's a clear ceiling for this oil market because of the supply?
I think it's far too early to say that. Clearly, despite the news today and clearly the impact that it's had, the situation in the Middle East remains very volatile. It remains fraught with risk, and I think oil traders will not ignore it. I think the flat price market clearly signals that lessening concern, but traders have also been taking a lot of protection against some of these risks in the option markets, and they will continue to monitor the situation and be alive to it. Yes, the supply and demand picture cushions some of those risks, and I always say the other cushion is the fact that OPEC Plus has a large degree of extra unused supply, idle supply that it could bring into the market if it wanted to. But I think the market is still very conscious of what's going on in the Middle East.
And fair enough. And so let me give you the last word, Jomana. Only about a minute here, but if Israel does have a more muted response, something like military bases, how do we understand what the response from Iran will be to the response from Israel, that's the response to Iran and so forth?
Yeah. I mean that's a big question. And we were speaking to Patrick Sykes, who is our Iranian correspondent, just a couple of days ago, and he said they've moved on to the second derivative in Iran now. They're talking about the potential response. But from what we understand, and from the language that has come out of the Iranian regime, there's been a lot of rhetoric, but there certainly isn't the perception out there that Iran want to get ensnared into this broader conflict. And again, it all comes back to the state of economy, which is crippled by sanctions. And you've got to think that they are also not in a position now to want to make this be escalated even further.
Okay, Jomana, Will, thank you so much. That's Bloomberg's Jomana Bersecci and Will Kennedy. More to come on your Bloomberg Brief. You're watching Bloomberg Brief. Danny Berger here in New York. Let's get you some front page news. A look at what's making headlines around the world. First up, the FT has this on the front page. The U.S. election bets are surging after a court lifted a ban. Institutional investors are placing millions of dollars in new wagers are being placed after Kalshi, a betting forum, won a court victory in Washington over a U.S. regulator and just fully opened the market. Bets do narrowly favor Trump over a Harris win. Next up, the New York Times has this on the front page, that Canada has been expelling Indian diplomats, accusing them of a criminal campaign, orchestrating homicides and extortion in Canada to intimidate Sikh separatists critical of India. Canada expelled India's top diplomat to the country and 5 others. India did reciprocate, expelling 6 Canadian diplomats. And on the Bloomberg this morning, the U.S. has been weighing capping NVIDIA AMD AI chip sales to some countries. The Biden administration is weighing implementing the cap on a country-specific basis. That all according to Bloomberg sources. For more, let's bring in Bloomberg's Tom McKenzie. Tom, what timing for NVIDIA hitting a new record high, riding high? What exactly are the details of this?
Yeah, absolutely. So look, we're going to be watching NVIDIA pre-market, right, on the back of this news to see how it reacts. It's up 14% so far in the month, about 200% over the last 12 months or so. Will this prove a headwind? So this is further evidence that the Biden administration continues to build out their framework. Oops, on that front, some technology dropping at my feet. Talking of technology, build out that framework around the restrictions that they're now applying around some of this technology. Of course, the AI accelerators, the GPUs manufactured, designed at least by the likes of NVIDIA and AMD, of course. The latest news is that they're considering this cap then on export licenses for this technology, interestingly, with a view to restricting some of this tech to the Middle East, the UAE and Saudi Arabia. So you can imagine there may be some tough diplomatic conversations that will be following on the back of this news. Again, it's a reminder, the Biden administration is trying to tie this thread, and it's a complicated thread, on the supply chains around AI accelerators that are needed for these data centers to train these models to ensure that it doesn't get into the wrong hands. There's this big push around sovereignty. We know they've taken steps around trying to restrict China from some of these AI chips. Part of it is that story as well, trying to ensure that China isn't getting these AI chips from other trading partners. So that could also be part of the ploy. The risk that some have flagged is maybe the US ends up losing out market share if the likes of Nvidia can't get exposure to some of these markets. Now, the Middle East will still be able to buy these chips, but there are these licenses. They'll have to go through that approval process. And again, the Biden administration hasn't yet confirmed these details, but it looks like they're heading in that direction, according to this reporting.
Yeah, and just to look at the equity prices, AMD down 1%, NVIDIA less than 1%. How much does it even move the bar for NVIDIA and enthusiasm around it, Tom, when there's just so much demand?
Absolutely, and we've had a reminder that they cannot meet the demand out there. Morgan Stanley, the analysts were on the ground at NVIDIA last week. They put a note out on this, and they said that they're seeing that ramp up in production for the latest chip, the Blackwell chip by NVIDIA, and that demand, they're already pre-booked 12 months out. And according to those Morgan Stanley analysts, they have transparency going out at least another 12 months. So the demand is there. It makes the supply chains more complicated, but the desire for these hyperscalers and sovereign nations to get their hold on these chips seems to be unabated for now.
Tom, we really appreciate it. Bloomberg Daybreak Europe anchor Tom McKenzie there in London. Okay, coming up, we're going to catch up with RBC's Wu Silverman. She points out a shift in sentiment in this options market. We'll explain that for you next, coming up on your Bloomberg Brief. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Oil slump, crude drops for a third day on speculation that Israel will not strike energy sites in Iran. And it's another record. Stocks notch their 46th all-time high of the year. NVIDIA posts its first record since June. And bank earnings continue. Bank of America, Goldman Sachs, Citi, all on deck. The equity market this morning is slightly weaker. Does it have to do with tech this morning of the U.S. looking at more chip curbs? NASDAQ 100 down about 0.1%. NVIDIA down 1%. Russell 2000, S&P little changed, but Global Fund Manager survey showing the highest adding to allocation since 2020. Bonds, meanwhile, not a lot of movement after yesterday's holiday curve, mostly lower for the most part. Maybe that's driven by oil. Over the past 2 days, oil down 6.3%. With this session and last, those reductions of perceptions of escalation and risk in the Middle East. Washington Post reporting that Netanyahu has agreed to limit its retaliation to military targets versus oil or nuclear facilities. Now, despite those geopolitical risks, a U.S. election in less than a month, a fog of confusing data, investors are approaching this market with unbridled optimism. I mentioned this. Bank of America's latest fund manager survey shows that there was the biggest jump in equity allocation over the past month since June of 2020. Cash positions fell, which analyst Michael Hartnett says triggers a sell signal for the bank. Joining us now is Wu Silverman, head of derivative strategy at RBC Capital Markets. Amy, great to see you this morning. Thanks for getting up early for us. So the cash equity market, unbridled optimism. Is something else happening in this options market?
Good morning. And it is, Danny. It's interesting because we've been talking about the tails getting fatter. And look, I'm a derivative strategist, so I guess I like to live in the tails. And that's an important data point for me because it means that although we're continuing to see all-time highs in the stock market, investors are more focused on hedging. You see that pickup in demand, and that's why you see those tails getting fatter. And I think it means, one, it could just be we're well positioned and we have something to protect, or two, we do see a series of events that could be quite volatile on the horizon, and we are a little bit concerned about what that downside could spell for the equity markets ahead.
How sensitive is it to things like the oil price, Amy? I just asked because oil is falling quite remarkably this morning. Usually this time in the morning, you don't see that big of moves, down 4% for Brent crude at this moment. How correlated are pricing and more tail risk to something like higher oil prices on geopolitical risk?
It's incredibly sensitive. And now I'll just give you one nuance. What we're seeing in terms of hedging is historic call volume, but it's not in the S&P 500. It's in all the energy ETF proxies, because one thing we've learned is when you have a stock market that's so heavily weighted to your Nvidias and your Apples and your Amazons and what have you, and energy is such a small proportion, you don't really see that bleed into the market, quote unquote, which is the S&P 500. So you have to go to more direct plays. We see energy investors buying XEG, OIH, XLE, those type of ETF upsides that could be triggered if there's more geopolitical risk.
That's really interesting. So, Amy, just overall on a sort of the bearish gauge, in terms of overall index level versus individual stocks, are we still mostly optimistic on those index options? Or are you saying that's also where you're starting to see some of that more bearish hedging come in?
So it's a great question, and we're actually starting to see more hedging come in on that index level as well. It's just not necessarily for something as specific as energy. There's obviously different outlets for that. But even on the S&P 500 level, where the first 6 months of the year were incredibly muted, I'm talking kind of tails at historic lows, even that is picking up, even though we have that concentration risk at the top. And to me, that's very telling about a shift in sentiment that essentially happened starting August 5th when we got that volatility spike. And it really never recovered in our markets. It's continued to shift more and more bearishly.
How does that set us up for this earnings season, Amy? An earnings season where it's been noted many times that the bar is low, something like under 5% year-over-year gains for earnings expected.
Yeah, I think this earnings season is critical. And typically, when you think about volatility, the first few weeks of earnings are when you get the most new information. That tends to be a good time to own volatility. Most investors are approaching earnings season very idiosyncratically, which shouldn't be surprising. So we're seeing more individual stock by stock hedges, and you see that pickup in put skew. So again, that demand and downside hedging for something like Nvidia. As these names start to come up, we'll see more investors place those demands either for upside or downside. But again, it's shifting more bearishly, even on something like financials. And we're starting to see people play those as those earnings come up.
Interesting. Financials, even after Friday, Amy, I mean, has there been a shift? Really strong earnings from JP Morgan again after the bar had been set kind of low for them?
Yeah, and the difficult thing is when we see this happening, the question is why? One, it could be a reaction to being long the stock position, right? So sometimes it's more innocuous, meaning we're long the stock and we're just simply protecting any downside scenario. We're not necessarily expressing it outright. What we do see sometimes is when that skew gets very, very high in magnitude, it might mean something else. We're not at that level yet, but I think as we get knee deep into earnings, you're going to get a clear picture of those volatility jumps.
In terms of event risk, Amy, we've been talking about the geopolitics, about oil falling 5% this morning, but there's another clear one, and you've pointed this out before, that the VIX does capture the election. But what about pricing after the election date? How set up for this market is something that might look like a contested election where we don't know the results right away?
Look, that's what I'm worried about, and I think that's what a lot of investors are worried about when you start to see these hairline margins on the polls, when you start to think about what recounts could look like. There's this election day hump, if you will, in the VIX, which is essentially telling you the market is worried about the event itself. But when you think about November 5th, which is U.S. elections, and then November 7th, which is actually the next Fed meeting, that entire week could spell a lot of volatility, and it could also drift into the following week. I've had a lot of pushback with clients on this. Some think this is a sell the news event. And to me, the one worry that continues to linger in my mind is, well, but what if we get sort of a 2000 style contested election where simply we just don't know who the winner is for quite a long time? I think that can sustain volatility. And if we think about that scenario, then really that volatility pricing could remain elevated even past that election week itself.
So what are you recommending clients to do to gear up for that, Amy?
Yeah, look, investors have loved to buy just the absolute shortest tenors they can. You see this perk up in 0-day to expiry trading. I would say think about owning a little bit of a longer tenor this time. Yes, I know it costs a little bit more, but perhaps in this particular instance, it's probably worth it. VIX call spreads or S&P puts are a simple way to be protected for this kind of event risk, which could be very drawn out, and we simply don't know until we get into the event itself.
Amy, really wonderful to get your thoughts this morning. There is a whole heck of a lot going on. Walking through all of it with Wu Silverman of RBC Capital Markets. We've been mentioning the jump in oil prices this morning. Let's just get another look. Going as high as 5%, slightly backing off of that for NYMEX crude. Brent crude down 4.8%. European nat gas, that's also tumbling 3.5%. Again, all of this stemmed from a Washington Post report late yesterday that Israel would be targeting military sites in Iran, not oil or necessarily nuclear sites. So that's some of that geopolitical risk premium being priced out. Just adding to that, the IEA out with a report this morning saying that even with the geopolitical risk, supplies are so abundant that it outweighs it. NYMEX crude, again, down nearly 5% at $70 a barrel. Okay, coming up, we count down to the big bank earnings. We have three more big ones on deck today. Opima CEO Octavio Morenzi is going to join us on what he expects on your Bloomberg Brief. This is Bloomberg Brief. You're looking live at the principal room. Coming up, former President Trump sits with Bloomberg editor-in-chief John Micklethwait. That's at noon in New York, 5 p.m. in London on Bloomberg. It's your Bloomberg Brief. Danny Berger here in New York. So we are counting down to the U.S. election, now exactly 3 weeks away. Candidates Donald Trump and Kamala Harris rallied voters with their economic plans at the forefront in Pennsylvania.
I had a great relationship with President Xi. We had a deal, and he was perfect on that deal. $50 billion he was going to buy. We were doing numbers like you wouldn't believe for the farmer. But the farmers are very badly hurt. The farmers in this country, we're going to get them straightened out. We're going to get your prices down.
So under my economic plan, we will bring down the cost of housing and help first-time home buyers, giving them $25,000 for down payment assistance so you can just get your foot in the door.
Joining us now is Bloomberg senior Washington correspondent Saleha Mohsin. Saleha, even though they've both been on the campaign trail so far over the past week or so, the headlines have been dominated by Trump, by different things he said about dance parties, about people fainting. How do we understand the momentum that Kamala Harris once had and whether it's still there?
Yeah, she started to, we saw in August and September was a little bit of the honeymoon phase of a new person on the Democratic ticket, that kind of settling in. And initial polls, it was kind of a little bit of a sugar high. Now that people's reactions are settling down, we're starting to see and hear more information from Kamala Harris, how she is similar to Biden, how she is different to Biden, how she is reacting to Trump. We're seeing polls settle down and Trump gain some momentum as the pair are making their closing arguments now.
I feel like we should just play some of Trump's rally yesterday just because of how odd and remarkable it was. So he turned his rally into an impromptu dance party after it came to a premature end due to some audience members fainting. Take a listen.
The number one issue this country has put on Pavarotti singing Ave Maria. Nice and loud. Turn it up. Let's not do any more questions. Let's just listen to music.
I'm not sure how much more we can add to that, Saleha, but just in terms of Trump's campaign tactic, he was in Pennsylvania there, a swing state, maybe more dance party than substance. But he also was in Coachella. He is also going to Madison Square Garden, doing events in Colorado. Why is former President Trump campaigning in not swing states, in places that are very solidly blue? What is the thinking behind that?
One theory is that he feels, him and his campaign, they feel really confident or pretty confident in their chances to win, and now he's going for the popular vote. He's never won the popular vote. The Electoral College win is how he got into office in 2016. And if their internal polling is so good that he thinks that he can spend time in states that have a lot of Democratic support for Harris, where the Electoral College is what's defining whether it's red or blue, then maybe he's just trying to really win on every level possible. I mean, if you look at the way he handled the rally, he's always been the kind of politician who just pays attention to what is happening in his support group, right? So someone fainted. The situation needs to change. The crowd is restless. Okay, let's turn music on. Let's get the doors open. Let's just change the situation rather than just sticking to the plan. He knows how to connect with his voters.
Now, over in Seattle, just elsewhere in what Washington is dealing with, U.S. Acting Labor Secretary Julie Su Saleha met with Boeing and striking union workers, urging them in their bargaining process. In this election year, are these strikes, is it an issue for these candidates? And how much sway does Washington even have at this moment, just again, 3 weeks away into an election?
The labor part of the country, that constituency has been an interesting one. Most labor leaders haven't endorsed a candidate. Kamala Harris tried very, very hard to get key support from labor leaders. What we've seen is a split where leaders tend to want to go toward Kamala Harris or before that Biden, and the actual union members are more supportive of Trump. And perhaps that's behind why leaders have not thrown their support to any one candidate, because there is this split and they do need to represent their own membership. But yes, you're right. There have been a couple of strikes this year. That is the key sector and the key part of the voting population that each candidate is vying for. The U.S. has turned into an economic populist country, and that means keeping union members and the manufacturing sector healthy and happy.
Saleha, thank you so much for joining us this morning from Washington, D.C., Saleha Mohsen. And don't miss our exclusive interview. John Micklethwaite, our editor-in-chief, will be sitting down with the former President Donald Trump, 12 p.m. Eastern Time. A quick check on you for your markets this morning. Equities, for the most part, lower. It is led down by tech. S&P 500 futures flat for the most part, as is the dollar. Got to be honest, not a ton of action in these markets. Bond markets back open after yesterday's holiday, down by about 4 basis points. The real action, that is in oil this morning. WTI down nearly 5%. Brent crude also nearly down 5%. The geopolitical risk premium getting priced out. Perhaps that is what is dragging bond yields lower too. This is Bloomberg. This is Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading day on this Tuesday. The main event will be before the bell. Big bank earnings from Bank of America, Goldman Sachs, and Citi. Again, all before the market open. We're also going to have some retail earnings today, too. Johnson & Johnson, Walgreens, that's before the bell. We'll also get United Airlines after the market close after an ever so slight disappointment from Delta last week. Enough to send shares lower, though. And, of course, don't miss Bloomberg's exclusive interview with the former President Trump. That is at 12 p.m. Eastern. Let's look at some individual stocks on the move this morning. AMD and NVIDIA both moving lower by some 1% after Biden administration officials discussed capping sales of advanced AI chips from NVIDIA in other U.S. chip makers. All of that according to Bloomberg sources. I mentioned there, United Airlines also has earnings after the market close. After Delta missed, there is a focus on capacity. And let's get a check on the banks as we head into their earnings just a few hours away. We have Bank of America, Goldman Sachs, Citi. Again, this might be a messy quarter with all the restructuring they're doing. Bank of America will be squarely focused on their retail business and how the consumer is doing after JP Morgan and Wells Fargo earnings both showed a solid consumer. Goldman Sachs, for its part, again, some of that will be on earnings. David Solomon setting the bar lower for earnings, saying it might be something like a 10% drop on trading specifically. All of that coming from the Barclays conference. But just across the board for these banks, what we have seen this quarter, set the expectations low and beat them. It's that old song and dance. Let me show you what oil is doing this morning. The other big mover. Oil markets down nearly 5%. NYMEX crude exactly 5%, just above $70 a barrel. Brent crude 4.8% lower. This after the Washington Post reporting that Israel would be attacking more likely military sites in Iran, not oil infrastructure, not nuclear infrastructure. So again, oil prices falling a whole lot this morning. Meanwhile, the IEA also saying that there's enough supply to outweigh even those geopolitical risks. Now, the other big concern of this market has been Europe and the economics of Europe. We do have an ECB decision this week, and in particular, it is the automakers that are feeling the squeeze. A lot of it comes from their Chinese competitors. That's led to some guidance downgrades and tough decisions. Stellantis CEO Carlos Tavares caught up with Bloomberg Surveillance yesterday about the industry. Take a listen.
We are leveraging a strategy that is based on two major pillars. There is one pillar with Leapmotor that brings EV technology at the price of ICE, despite the tariffs that you are mentioning, because we can go around the tariffs by manufacturing the cars inside of the bubble. That's one. On the other side, we have a dedicated platform that we call the Smart Car Platform that we are using to bring compact cars to the market, like the new Citroën C3 that we bring to the market at 23,000 euros, which is the core of the market in terms of pure EV, and that price is extremely competitive. It's on par with the Chinese capability, and that kind of offering is also profitable for Stellantis. So not only we have the pillar of Leapmotor, which is very strategic, we also have the internal pillar, which is the Smart Car Platform that we are now using, for example, for the C3 Citroën hatchback, but also for the C-Cross crossover version, and many other models will follow, Fiat models, but also Opel models, and that is going to bring a lot of competitiveness to the market. So what I'm saying is that Stellantis is in a perfect condition to leverage affordability with profitability and zero emission in the near future.
That was Stellantis CEO Carlos Tavares on the company's EV strategy amid competition from China. Just as a reminder for Europe, we're going to get an ECB decision that comes on Thursday. The market pricing in nearly 100% odds that they will cut by 25 basis points. The conversation has been, though, should they go more? Should they go more with the Fed that's already cut by 50, with employment that's weakening? Of course, the ECB doesn't have that dual mandate, but is the labor market enough that the ECB can't feel comfortable in a slower pace of cutting? So again, odds are for Thursday that they will cut by 25 basis points. So as I mentioned, big bank earnings continue. We're going to get Goldman, Bank of America, and Citi before the market open. That's after a strong start by JP Morgan and Wells Fargo on Friday last week. Just take a listen to what JP Morgan CEO Jamie Dimon said on that earnings call.
Quite clear that I think the future could be quite turbulent. Cash is a very valuable asset sometimes in a turbulent world. And you see my friend Warren Buffett, stockpiling cash right now. I mean, people should be a little more thoughtful about how we're trying to navigate in this world and grow for the long term for our company. I prefer to wait. We will be able to deploy it. Our shareholders will be very well served by us waiting.
So for the most part, the consumer is strong. The credit picture is much better than they expected. But, those little signs of maybe some worrying, like Jamie Dimon saying that there's still a desire to hoard cash and at the same time increasing their credit provisions, too. There was also a moment on that call where he basically admonished the analysts for focusing on guidance for NII, basically saying next time, let's give them the damn number. That is a direct quote from Jamie Dimon. Even with any of the risks out there, there's still unbridled optimism in this market. I want to take you to the latest global fund manager survey from Bank of America, saying that investors have registered the biggest jump in optimism since 2020. Cash levels at the same time fell to 3.9% from 4.2%. So where is that cash going? Supposedly, it's going into equities. Again, that's over the past month. All of that, they say, is triggering a sell signal. Despite that, the top three tail risks are geopolitics, 33% pointed it to that, 26% say inflation, just 19% say U.S. Recession. Still, the crowded trades, it won't surprise you, it's the same it's been all year. The Mag 7, 43%. Long gold comes in at second at 17%, saying that. Equity markets are weaker this morning. The big move to the downside is oil, down nearly 5%. That is it for your Bloomberg Brief. Surveillance will take it from here.